Debt spiral. This one doesn't start with fireworks. It starts with math. Think about living on credit cards. At first, it feels manageable. You make the minimum payments, swipe when you need to, and keep life going. But then you wake up one day and realize the interest alone is bigger than your grocery bill. You borrow just to cover the interest, and then you borrow again to cover the new interest. That's a spiral. For the US dollar, this shows up when interest on the national debt becomes one of the biggest expenses in the entire budget. Bigger than schools, bigger than defense, just interest. The problem compounds because the more you borrow, the more investors demand higher rates. And the higher the rates, the faster the spiral accelerates. You would feel it as a regular person in small ways that build into big ones. Mortgages that used to be 3% suddenly cost 6%. Car loans stretch your paycheck thinner. Companies stop hiring because borrowing to grow is too expensive. Retirement accounts stagnate because the bond market doesn't trust the government anymore. It doesn't feel like collapse. It feels like suffocation. The trap is in thinking we've always had debt, so we're fine. But when compounding flips sides, it turns into quicksand. The spiral doesn't need to finish overnight. It just needs to keep tightening until confidence cracks. And when confidence cracks, the dollar loses its edge. Confidence shock. The second risk is about trust. The dollar is only paper and pixels. What makes it powerful is confidence. Break that confidence even for a few days, and people start looking for the exits. Picture waiting on your paycheck. Your boss tells you, "Don't worry, it's coming, just not today." You'd start questioning whether the job is stable. That's what happens when the government plays games with the debt ceiling or delays payments by mistake. The country isn't bankrupt, but the world sees a crack. Markets react instantly. Treasury bills that were once the safest asset on earth start trading like risky bets. Investors demand extra yield just to hold them, and that little extra costs billions. Money market funds wobble, banks hesitate, and suddenly, a technical glitch in Washington becomes a global issue. You'd feel it as turbulence in your 401k or sudden hesitations at your workplace. Promotions freeze, loans get harder to secure. The danger here isn't insolvency, it's perception. Because when the rock looks shaky, the whole wall starts to tremble. And once you've shown weakness, regaining trust takes far longer than losing it. Runaway inflation. Inflation is already something everyone understands because we live it at the checkout line. But runaway inflation isn't about numbers on a chart, it's about behavior. Imagine you get paid today. Instead of saving, you rush to spend it because you know next week it will buy less. Your neighbor does the same. Businesses catch on and raise prices constantly. Suddenly, you're trapped in a loop. Wages chase prices, prices chase wages, and the value of the dollar erodes every single day. This has happened before. In Germany after World War I, in Zimbabwe, in Venezuela. Currencies became so worthless that people carried wheelbarrows of cash just to buy bread. The United States isn't there, but the mechanics are the same. When people lose faith that their money will hold value, the dollar melts. For you, it would feel like groceries rising week after week. Landlords demanding higher rent mid-lease. Raises that never catch up. Even if you're earning more, your lifestyle shrinks. At first it feels like annoyance. Then it becomes survival. Hyperinflation doesn't show up like an explosion. It creeps, and then it crushes. Reserve erosion. The fourth risk is the erosion of reserve currency status. The US dollar is the world's favorite tool for trade. Oil, metals, food, it's all priced in dollars. Central banks around the globe hold dollars as their reserves. But that dominance is not eternal. Erosion happens quietly. A few contracts get settled in another currency. Central banks diversify into gold. A new regional system rises to settle trade outside the dollar. At first, the changes look tiny, but as they compound, the global demand for dollars shrinks. For everyday people, this means imports get more expensive. Trips abroad cost more. Companies reliant on foreign supply chains pay more and pass it along to you. Suddenly, the dollar doesn't stretch the way it used to. The danger is in assuming reserve status is permanent. History tells us it never is. The British pound held it before the dollar. Before that, it was other empires. The dollar doesn't need to disappear to hurt you. It just needs to matter less, one trade deal at a time. Energy shock. Growth runs on fuel. If energy prices surge or major producers decide to ditch the dollar for trade, the currency feels the shock. Imagine filling your gas tank and finding the price doubled in a month. Flights get more expensive. Shipping costs spike. Groceries climb because fertilizer, trucking, and packaging all depend on energy. Energy is the invisible tax embedded in everything. You might think, I don't drive much, I'm fine. But energy lives inside every product you buy and every service you use. When it spikes, your entire budget feels it. And when producers stop pricing energy in dollars, the global demand that props up our currency takes a hit. The US has survived oil shocks before, but the dollar's position today makes it especially sensitive. When the world questions whether it even needs dollars to get fuel, that's a slow bleed on trust. And trust is what the dollar really is. Treasury crack. Next is the Treasury market itself. Treasuries are supposed to be risk-free. They're the foundation under global finance. But what happens when the foundation cracks? If buyers step back, or if dealers stop absorbing supply, yields can jump in ways that break models overnight. Mortgage rates spike. Companies suddenly find borrowing twice as expensive as last quarter. Portfolios built on the assumption that treasuries are stable start to wobble. For you, it shows up as a jump in mortgage quotes, or your retirement fund losing money in the safe bucket. The system that was meant to be boring suddenly turns violent. The myth is that treasuries will always have buyers. That's true, but at what price? If the price moves violently enough, the collateral chains that support modern finance start to snap. And when the base layer of trust in the financial system looks unstable, the dollar sitting on top of it looks unstable too. Shadow squeeze. The next risk doesn't live in the headlines. It lives in the plumbing. Repo markets, swaps, euro dollars, all the hidden channels of dollar funding. When collateral haircuts rise and margin calls spread, the shadow system seizes. Everything sells off at once, even assets that should hedge each other. Why? Because when funding dies, selling is the only option left. You'd feel it even if you never touch derivatives. Suddenly your line of credit shrinks. A business loan gets pulled. Investments in your retirement account drop for reasons the news can't even explain clearly. The danger is that you don't need to be levered to suffer. If your counterparties are levered, you're still in the blast radius. A squeeze in shadow markets is like clogged arteries in the heart. You might not see it from the outside, but when it locks, the whole body collapses. Banking crisis and the printing backlash. Banking crises always start with whispers. A few depositors pull money, a rumor spreads, and then, in a flash, a bank run. The government steps in, backstops deposits, floods the system with liquidity. At first, it calms nerves, but long-term, people start asking, if we can always print to rescue banks, what's the currency worth? It's a whiplash effect. First, fear of bank safety, then fear of the money itself. For you, this looks like frozen credit. Businesses telling you they can't approve loans right now. Your savings feel shaky. The fear spreads faster than the facts. Printing rescues save banks, but risk the dollar's credibility. If confidence in banks shifts into doubt in the currency, then the problem escalates from a local fire into a global storm. Twin deficits. This means the country is running both a budget deficit and a trade deficit at the same time. It's like a household spending more than it earns while also importing everything on credit. At first, foreigners are happy to fund it because the dollar is strong. But over time, they demand better terms or start walking away. The dollar weakens, imports cost more, inflation gets stickier. You'll feel it when everyday goods with foreign supply chains get pricier, while wages don't keep pace. Living standards erode not because of crisis, but because of constant leakage. It's death by 1,000 cuts. The danger here is complacency. Deficits have been around for decades, but when trust in the dollar fades, those deficits stop being easy to finance. And once investors hesitate, the spiral begins. Digital competitor. Currencies compete on trust, but also on convenience. If a digital alternative, whether it's a central bank digital currency, a stablecoin, or some other rail, captures trade flows at scale, the dollar quietly loses ground. Picture companies settling international trade in a token, or a regional bloc using its own digital currency for energy and metals. The dollar doesn't disappear, but the demand softens. And that demand is what props up the dollar's global status. For you, it looks like more payment options, maybe even lower fees. But behind the scenes, the dollar's monopoly shrinks. And as it shrinks, so does its power. The risk here is dismissal. Digital competitors aren't toys, they're infrastructure. And when infrastructure changes, everything built on it changes too. So, what would a dollar collapse feel like to you? It's not the Hollywood version with sirens and riots. It's a slow erosion. Groceries that get pricier every week. Mortgage quotes that make no sense. Trips abroad that suddenly double in cost. Employers freezing raises. and the quiet realization that the dollar in your hand isn't stretching the way it used to. The collapse of a currency isn't about a single event. It's about losing trust, one crack at a time, until one day the foundation gives way. But you aren't powerless. Build your buffers, diversify your assets, lock in fixed rates, strengthen your skills. The dollar might bend, but your ability to adapt is the true hedge.